this year. Our next guest is pretty confident he can beat that by a considerable margin. Kishore M, the CEO at Commerce Capital of Singapore. Come in July, they're launching a new hedge fund mostly focused on the derivatives market. Kishore, welcome to the program.
Thank you so much.
Not only are you launching a hedge fund at a tumultuous time when a lot of them have been experiencing some rough terrain, you're not even a conservative hedge fund. You're going to be so tied to strips and straddles and butterfly spreads and leaps and options and buy and writes. How are you going to manage that kind of risk?
Yeah, that's a good question. Actually, I've been trading my own proprietary funds, and we've been doing pretty well. So we've seen our ups and downs, and that's the reason why we're very confident that we'll be applying the same technique that we've been using for our proprietary funds into the hedge fund that we're going to launch.
Describe your philosophy, because it is, I mean, this could change, of course, depending on the environment. But 75% is going to be pure derivatives, isn't it? I mean, you're going to be arbitraging in the options and futures markets, and that could be commodities, that could be stocks, that could be frozen concentrated orange juice, that could be palladium futures.
Absolutely.
Where are you going to aim this money? Is it going to be across the globe, 360 degrees?
Absolutely. We are a multi-asset strategy, multi-neutral, market-neutral strategy company. The reason is because we look at volatilities, and we move across verticals where the volatility is low. So the reason we have to be multi-asset is if the volatility is very high in a particular asset, let's say currencies, which we have seen recently, the euro and the US dollar. We move out of currencies and we get into indexes. If the indexes gets, or the stocks gets very volatile, we move out of indexes, we get into commodities like gold. Right. So that is why we have to be multi-asset.
Now, is this a proprietary fund you're going to manage yourself? Are you farming out any of the management of these funds?
No, everything will be managed by us.
So you're not hiring hedge fund managers. You're not going to be a fund of funds in any way.
No, we're not a fund of fund. We're a single manager fund.
Right. How many people do you have working for you?
Currently, we have 4 of us.
There's 4 of you going to cover pork bellies, frozen concentrated orange juice, palladium futures, and greasy wool futures.
Well, we're just starting, and we're not going to do everything at the same time. Like I said, we look at volatilities across different asset class, and we move at one asset class at a time. We're definitely going to scale up our operations as the fund grows.
Okay. Now, the other 25% is going to be shares and futures, right? It could be some derivatives, it could be some long positions, some short positions. That's not going to be Asian. That's going to be quite. That's going to be very much U.S.
More U.S. Yes. We're looking at something called as leaps, which are long-term options. We're going to use a buy-hold technique, which is what has been the traditional way of buying equities, but using leaps, which is long-term options. So we get the advantage of low investment, as well as we have the opportunity of time, which is on our side. So we can wait in there and wait for the opportunity at the right time.
Right. You know, if you talk to the people, like one of the, Jim Rogers, you know the name, who helped Julian, I'm sorry, George Soros founded the Quantum Fund, has said in the recent past that, you know, maybe the heyday is over. Greenspan has come out and talked about hedge funds. You heard from Snow earlier. And Greenspan, you know, saying, well, you know, it's become so common vanilla now to be exposed to a hedge fund. You don't have that special aura. You don't have that kind of specialization. There's too much money in them, too much liquidity sloshing around. It's going to be hard to achieve the kind of returns that they used to be famous for. Does he have a point?
Yes, he does have a point, but you must also look at there are different types of hedge funds. Maybe he's particularly looking at a particular type of fund which is looking at arbitrage opportunity or looking at mispricing. What we are doing is we're not going into that side of the hedge fund. We're looking at basically more of writing options, where in time, we're looking at time value, and we don't really care about where the market goes. What we're really looking at is non-directional, where we are long and short both at the same time. And that is why we really don't belong to that type of a hedge fund class, which is what maybe Alan Greenspan is referring to.
It sounds like you're not too worried about the fundamentals. You're taking a very quantitative approach to these. I mean, you're looking at you're looking at options expiries, you're looking at cover to bid, you're looking at basically yield to maturities, and just doing the math on it. I mean, it sounds like you can actually make investments without even knowing what you're investing in. I mean, not that you would, but you could.
Yeah, actually, we spend a lot of our time on statistical risk. And if you look at the CME source, Chicago Mercantile Exchange, they say almost 75% of the options expire worthless. And that's a very important statistics for us, which we look for. We also look at the VIX, which is the volatility index. So a lot of our research goes into the statistics side of looking at whether is this option. We look at more high probability rather than high return.
That's so 75% of the
Chicago Mercantile Exchange
expire worthless.
Expire
it's
worthless.
like you pay insurance, a term insurance policy premium,
which just expires,
and you don't die.
No, if you pay, it just expires.
Right.
So you lose.
It's a waste of money.
Yeah, it's a waste of money.
So you want to be the one that takes the premium and sells those contracts to those suckers then.
Well, you could.
Hey, no, hey, if I'm investing in your fund, I don't mind if you sucker people like that. Housekeeping here. Minimum investment $50,000
Yes.
US. Where can you sell it? Are we in Singapore? No. Anywhere in the world?
Anywhere in the world except US.
Why?
Well, we are an exempt fund.
Oh, okay.
And there are certain restrictions. And that's the reason.
Okay, and you can sell it in Hong Kong, for instance. It's an unauthorized fund, so you can't actually market in the paper, but if I come to you as an investor, no problem.
No problem.
Okay. No upfront sales charge.
Yep.
No redemption charge.
Yep.
No annual fee.
Yep.
But a whopping 20% performance fee. But that means that you have to make me $1
Sure.
to make 20% for yourself.
Sure.
Is that correct?
Absolutely. Absolutely.
Is that an unusual pricing structure? You're kind of putting your money where your mouth is, aren't you?
Well, if you look at what you just said earlier, hedge funds have not been doing well. I mean, people look at hedge funds as an asset which can give them a higher return, but some of them have not done well.
Yeah.
I believe that you should only charge if you perform. And looking at what's been happening in the past, I think more and more people, when they start looking at hedge funds, they're going to question about their ability to perform.
Okay, Kishore, best of luck, okay? July 31st, launch for Kishore M and his hedge fund. That'll do it for Bloomberg Live. Have a great weekend. See you Monday.